This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, live on radio, TV, YouTube, and Bloomberg Originals. This is Bloomberg Businessweek Daily. Massar, Tim Stenovec. That S&P 500 record run, taking a little bit of a breather today.
Yeah, it is, but, could be coming back because we're off our worst levels of the day. In fact, we were in the green just moments ago. The S&P 500, we can go ahead and call it flat, but lower right now. Charlie Pellet's going to have the details.
It's almost like we're waiting for some big tech earnings.
Yeah,
are we? Yes,
I think we are. Yeah.
All right, so a lot to come. Hey, we're going to talk about that. I will say a lot of the Mag 7 names we have seen down for most of the day. Our focus this hour is, first of all, Tim, the future of the Fed chair.
Yeah, also the impact of the administration on General Motors and Coca-Cola. Both of those companies reporting results and trading lower.
And possible private credit pitfalls and a tough childhood. We are going to go private with the head of Carlyle Group, CEO Harvey Schwartz. That's all to come in the next 60 minutes. First up, let's get a check on that trade. Here is Charlie Pellet.
I thank you very much indeed. Ahead of big tech earnings tomorrow, Alphabet, Tesla, those are up next. We've got Alphabet shares advancing now by 0.3%. Tesla up by 1%, and the Bloomberg Mag 7 index lower by 0.5%. Right now, the Dow is higher. Dow Industrials up 90 points, gain there of 0.2%. S&P lower, little change, swinging between gains and losses, down a point right now, little change there. The Nasdaq Composite Index down 0.4%. The Nasdaq 100 Index down 0.5%. And again, ahead of big tech earnings tomorrow, the Bloomberg Mag 7 Index down right now by 0.5%. We've got the 10-year 4.33% with a 2-year 3.82%. Spot gold up $32 the ounce, $34.29 now, up 0.9%. While West Texas Intermediate crude is down 1.5%, $66.18 a barrel. Bitcoin, meanwhile, up 1.9%, just above $119,000. Microsoft is accusing Chinese state-sponsored hackers of using flaws in its SharePoint document management software in a hacking campaign that has targeted businesses and government agencies around the world. Microsoft shares today down by just about 0.7%. Kohl's shares are surging up 39%. Minting the department store operator is the newest meme stock amid an influx of mentions by retail traders on social media. And Opendoor Technologies, it jumped 42% yesterday. Opendoor today, right now, is trading lower, giving back a lot of those gains, down by 14%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Headline crossing the Bloomberg terminal. Synovus Financial, it's a regional bank in the southeastern part of the United States, weighing options, including a potential merger after drawing some interest. This is according to people familiar with the matter. We should point out the stock, no surprise, ticker SNV, it is popping on the news, Tim. It's up about 5%.
Deliberations ongoing. There's no certainty that Synovus will decide to pursue a transaction. The people said a representative for Synovus did not respond to requests for comment. As Carol mentioned, the stock popping on that news.
All right, we'll keep an eye on that one. In the meantime, I want to get to something that is certainly among the most read stories on the Bloomberg on this Tuesday. Kind of asks some questions. Will he or will he not? Should he or shouldn't he? Will they or won't they stop talking about Fed Chair Jay Powell leaving the Fed? The he, of course, is the Fed Chair. The they is President Trump and a few key advisors, including U.S. Treasury Secretary Scott Bessent. Here's what he had to say earlier today on Fox Business.
I know Chair Powell. There's nothing that tells me that he should step down right now. He's been a good public servant. His term ends in May. If he wants to see that through, I think he should. If he wants to leave early, I think he should.
All right, that, of course, was U.S. Treasury Secretary Scott Bessent earlier on Fox Business. We should point to President Trump in the Oval Office just around noon Wall Street time today with the president of Philippines. They were talking about trade, but most of the conversation and certainly questions with reporters dealt on a lot of other topics, including the future of the Fed chair. He, too, talked about the Fed chair, but seemed to say, you know, his term is up soon, so perhaps maybe he will stay in that position. But anyway, there was some commentary from the White House as well. All right, let's get into it because we're kind of trying to figure out what this all means in terms of the pressure on the Fed chair and what it means for monetary policy. Stuart Paul is U.S. economist for Bloomberg Economics, and he joins us here in studio. Stuart, the drumbeat seems to continue and the pressure on Fed chair. First of all, I mean, will Jay Powell do anything different because of it? And might he step down?
I certainly don't think that he's going to step down. I don't think that he's going to do anything different. I think that the major question,
and by anything different, meaning he's going to do what monetary policy. Got it.
I think that he's probably still expecting 2 interest rate cuts this year. He probably still plans on delivering those 2 cuts probably in September and then in December. I think that that's his baseline expectation and what he's hoping to deliver. I think that the bigger question, and hopefully one that someone will ask next Wednesday during the press conference following the FOMC decision, I think that the big question to ask is whether the FOMC members feel compelled to stand pat and, in the face of political pressure, show their independence, assert their independence, and is this political pressure, in fact, making them inclined to wait a little bit longer? If Chairman Powell is intending to cut in September, does the political pressure give him some incentive to assert his authority and wait perhaps a little bit longer? I don't think that he would answer in the affirmative.
You mean one of those, I'm in charge, and to show you that, I'm going to even hold off even longer.
The political pressure coming from the West Wing probably has the opposite of the intended effect.
You know,
that makes it political.
That makes it extremely political. And I think what that reminds us of is the fact that Chair Powell is, yes, the chairman of the Federal Reserve, but he's not the person who sets monetary policy uniformly.
Right.
There's a committee here, and I think one question that I have is why over and over again he seems to be the target of the ire of the president rather than other members of the FOMC.
Well, so as the chairman, he is the most powerful. He attracts the most attention. He's the one whose voice is heard most clearly by financial markets. He's not the most public. As a speaker, of course, you get all the Fed branch presidents. You have Governor Waller just this week speaking publicly, or last week, I guess, on Bloomberg TV and radio. And I think that what's most important is that the chairman is the person who tends to set the tone for the committee, and it's very rare that you get a lot of dissents on the committee. As the chairman sets the direction, as the chairman sets the agenda in terms of policy making and regulatory rule makings, so follows the committee, usually. And the question around the committee will be just how willing are people to dissent from the chairman. And I think that we're going to see a dissent next week with Chris Waller, maybe 2, perhaps even 3 people dissenting.
President Trump, I want to clarify kind of what he exactly said in the White House around 11:43 this morning, Wall Street time. He did say, he was asked about Powell resigning. He's going to be out in 8 months, basically, he said. And he says he's got the rates high probably for political reasons. Based on the economic backdrop, should Fed Chair Jay Powell cut rates? Like, does the economy tell you that, and all the data say that, yep, we do need a rate cut?
Most of the headline figures would suggest no.
Okay.
Right? Private domestic final demand, which is growth in personal consumption expenditures and fixed investment, is running at an annualized pace of about 1.5%. Yes, that's down from about 2.5%, which is the average pace of the last 2 years. But unemployment is low, inflation is relatively contained, and so the headline figures would suggest that the Fed can at least afford to stand pat for now. I think that the best argument for cutting right now is that labor demand appears to be waning. Folks are leaving the labor market, so perhaps the decline in unemployment is not exactly a sign of labor market robustness or resilience. And wage growth and aggregate labor income growth is basically grinding to a halt. And I think that those are the items that have been flagged by Governor Waller. And I think that those are going to be the reasons why he wants to dissent instead vote for a rate cut just next week.
I want to throw something at you, Stuart, because one element of the big, beautiful bill that which named by the president, of course, and his allies, is the idea that ICE is getting more funding. And the president and Kristi Noem, who heads up DHS, has talked about just this week sending more ICE agents to New York City and around the country. I'm wondering, from an economic perspective, the effect that this has on the labor force It's a group of workers that traditionally hasn't been included in a lot of the economic figures that we talk about a lot. What's the back of the envelope math that you've done to indicate how this could affect inflation?
So it is very difficult to identify the consequences of undocumented workers in the economy. From the Fed's perspective, you have to think about both elements. You have to think about undocumented workers as a source of available labor. And so the fact that you have those additional workers actually loosens the labor market, suppresses wage pressures, and suppresses inflation pressures. But the fact that they are also consumers in the economy creates inflationary pressures. And so the question is, what is the net effect of those? I think personally the net effect has been inflationary. There's been there's been more rapid consumption, more robust consumption contributed by those undocumented workers than there has been their integration into the formal economy and into the formal production process within the economy. And I think that for that reason, the net effect of the immigration crackdown is going to be at least modestly disinflationary from the Fed's perspective. But again, under the surface of all these labor market numbers, we're trying to disentangle the effects of these immigration crackdowns. It looks like you do see some effect. One is that there's a rotation from foreign-born workers to native-born workers in the household survey, and there's also an effect in the payroll survey when industries that rely heavily on foreign-born workers have to then rotate to documented workers. Those payrolls get buoyed just a little bit. And you did see it in the April survey, you saw it in the June survey. So you see some of these inklings that, there are hints that payrolls are even being buoyed by this rotation from undocumented to documented workers.
All right, we got to run. Good stuff. Stuart Paul, U.S. economist at Bloomberg Economics, joining us here in studio. We want to stay in studio and just remind everybody there are really two big issues that seem to be stressing out investors and continuing. Tariffs, of course, and what the Fed may or may not do, and the pressure on Jay Powell, which is something we just talked about with Stuart Paul. Our next guest, certainly familiar to our Bloomberg audience, and has to take all of these big macro factors into account when thinking about the financial markets and figuring out what might be the possible impact. Great to have with us Monica Guerra. She's Executive Director, Head of U.S. Policy for Morgan Stanley Wealth Management, right here in studio. Good to have you here. There is a lot coming at investors and strategists and trying to figure out our way forward when there's still a lot of unknowns. So I am curious, first of all, with the pressure on Fed Chair Jay Powell, do you believe he could step down early?
I think it's up to him, right? The decision, there's no rule that says that he can't. In our view, we do think that he's likely to see the term out as only 8 more months, right? So this is important to keep at the forefront of this narrative. It's also important, I think, to Vicent and others to have stability within Treasury markets. So that is a critical factor in all of this.
So why does this Treasury Secretary, though, sometimes seem to put pressure on Fed Chair Jay Powell?
Well, that's because you have a president that's looking for a lower 10-year rate. You know, his background, you got to remember, he's a real estate guy, and having, more accommodative lending policies, right, is right in line with that. So,
but the Treasury Secretary is no stranger to Wall Street and understanding the importance of the Fed chair. I mean, for him alone, I think it's kind of interesting, or is it?
Which is why I think I want to agree with you in that it is interesting, but he's important in that he was a big voice of reason when it came to the initial tariff announcements, for example, right? He came in, he essentially coached the president through, especially when Treasury markets became unstable. So you have to remember that this is also something that is still top of mind for him. So I think what he's trying to do is balance policy priorities, what the president wants versus what is good for the markets.
In your view, what is more important to the markets, an independent Federal Reserve or clear trade policy?
Probably independent Federal Reserve, I would say, right, as far as being able to work with the committee, right, and actually, come up with the decision on the dot plot, right, of where they're going. Would
you say that independence has been threatened over the last few months by the president?
I wouldn't say it's been threatened. What you're looking at is a president who continues to voice his personal opinions. Powell has continued to do his job, right, the way that, he feels is the correct, order, right, in an independent fashion. You have the Supreme Court case that essentially created a carve out for the Federal Reserve specifically, so for further, adjudication if necessary. So I don't think this is a one and done, but I would really like to change the conversation to the tariff piece, because even though I think that having, a stable Fed is maybe more important for the economy, at least from a market's perspective, if we're thinking about tariffs, that's going to have a huge impact longer term potentially on the inflationary piece, which ties in to that interest rate argument.
And don't hate me because I want to go back there, because can the Fed chair and the Fed and the FOMC really determine the right policy before knowing exactly what all the tariffs and trade, you know what I mean? Like, until they know the specifics on the tariffs that are going to be imposed, like, can they really determine the right policy? And are they smarter to say, let's hold off a bit? Because if they're not as onerous and growth picks up and inflation picks up, right, they don't want to cut rates, raise rates, right? That would be maybe more problematic perhaps for markets.
Right, but I just want to say, in this discussion, you were talking about this desire to hold rates low. I think that if you're looking at the Fed, they're in a homeostasis right now because of all these factors, right? The data hasn't led them completely to a place where we have core economic weakness. We're seeing some initial softening in some of the data. We have to see how that all pans out. We have to wait till August 1st to get all of the tariff news in.
So on that, why would you say the tariffs haven't necessarily been inflationary at this point? Whereas 3 months ago in our studio, guest after guest was saying, just wait to see the inflationary effects of this. It hasn't happened.
So you had a pull forward in demand, right? You had suppliers ordering ahead of time. You had a full inventory restock. What we're seeing is that inventories are starting to, fall off. As soon as those new orders come in, right, at that higher level, that can be inflationary, right? It's going to be cost shared both with the company, right, the business, and the consumer. The other thing I want to note is that the dollar, right, is actually down about 10% from the beginning of the year. What that means on the import front is that weaker dollar means you are paying higher import costs. Doesn't matter what the average effective rate is, your import costs are now higher on a nominal basis. Right. So again, that is also inflationary, which is why I think it is, astute of the Fed to hold off and see where the data takes them.
So net, do all of this in terms of what the longer term impact, do you have a good feel about, I don't know, I feel like we go from day to day in terms of what comes out of the White House, which is fair and probably accurate. But I'm just curious, do you have a better feel of, like, by the end of the year, there'll be some higher tariffs, but maybe not so onerous, and, we'll start to see growth come back? Like, how are you kind of gaming this out?
So you're going to have a baseline of 10% on any country, right? On any country that you don't have a final deal with. Which is a lot higher
than what it was.
Right, a lot higher, right? So at least 3 times higher. So if we're looking at the average effective rate right now, it's about 12 to 15, depending on how you're counting. If you look at the most recent deal, I think with the Philippines, right, that's a 19% tariff just off of the 20. So while we're seeing some capitulation, right, and some negotiating downward, we could be at some of the same reciprocal levels that we saw on Liberation Day. I think that would be a surprise to the markets. You might get some interim volatility in response, but then it becomes an idiosyncratic risk and sorting through which sectors and industries could be most impacted.
Yeah, I mean, it's just, there's, as you say, right, each market, each country, each industry, it's really specific. And so there's a lot of detail in terms of figuring out the impact. Monica, thank you so much. Really appreciate it. Monica Guerra, she is Executive Director, Head of U.S. Policy at Morgan Stanley Wealth Management, joining us here in studio. All right, you are listening and watching Bloomberg Businessweek Daily on a day where we've got some earnings coming your way, some big tech earnings, certainly kicking off tomorrow, and we've got markets that are mixed. Coming up, though, we're going to get into 2 stocks caught in the crosshairs of White House policy. That on Bloomberg Businessweek Daily continues.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a number of developing stories. SpaceX is warning investors Elon Musk could return to politics. The language about Musk's potential future political involvement was added to paperwork sent to investors discussing a transaction which values SpaceX at about $400 billion. In the meantime, Tesla shares right now, Tesla shares are gaining. Tesla up by 1.1%. We're also keeping an eye on a developing story involving Synovus Financial. That's a regional bank in the southeastern U.S. Sources tell Bloomberg Synovus is weighing options, including a potential merger after drawing interest. Synovus shares right now up by 6.7%. The Dow Jones Industrial Average trading higher by 116 points, up by about 0.3%. We've got the S&P 500 index a little changed on the day, has been swinging between gains and losses, but right now down by less than half a point. NASDAQ, meanwhile, down 86 ahead of big tech earnings tomorrow. Right now, we've got NASDAQ down 0.4%. The NASDAQ 100 index down 0.5%. Tomorrow, of course, we will be hearing from both Tesla and also Alphabet. The Bloomberg Mag 7 index down 0.5%. 10-year 4.33%. The 2-year 3.82%, while the 30-year 4.89%. Spot gold up $33 the ounce, up 1%, and West Texas Intermediate crude down 1.4%, $66.27 a barrel. So again, recapping here, we do have the S&P 500 index trading a little change now, down by half a point. Ozzy Osbourne, the Black Sabbath singer and godfather of heavy metal, has died at age 76. Only weeks after his farewell show. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Few stocks on our radar, including Tesla and SpaceX. Charlie mentioned it. You've got shares of Tesla bouncing around down. Actually, now, is it up about 1.3%? I guess so.
It dipped a little bit right when the headline came out. It was below 1%, but now back to where it was before.
So bouncing around. All right. The other stocks, and I got to say, like, all of these names are feeling the impact of actions by or connections to the Trump White House. So let's get to it. First up, we want to talk about Coca-Cola, which said it plans to launch a new Coke product for American consumers, Tim, made with U.S. cane sugar this fall. It's something the administration kind of wanted them to do.
The shares of Coca-Cola traded down nearly 2% at its lows today. Bloomberg Intelligence senior analyst for consumer products, Ken Shea, joins us from New Jersey on Coca-Cola. Ken, we spoke to you last week. July 17th, you joined us. You also had a note out that said Coca-Cola was unlikely to move completely to cane sugar. I should say you were absolutely right about that. They are not getting rid of high fructose corn syrup. It sounds like what they're doing is coming out with a new cane sugar version of Coca-Cola. What can you tell us?
Yeah, hi, Tim. Well, as we expected, and fully in sync with what Coca-Cola has been saying all along, and that is it wants to be a full beverage company. So if there's a demand for a niche or a segment of the market that it feels it can play in there economically, it's going to do it. And so the cane sugar product extension, really, of the brand Coca-Cola is no exception. We already know there's a demand for it. Lots of consumers like the Mexican Coke, they call it. Gets imported into the U.S. in some selected markets. There's actually some small competitors that use it. Only small competitors because it's a more expensive version of a sugary drink. High fructose corn syrup is much less expensive. But I think Coke is really smart in bringing this out, not only because it appeases the president, but also because it is a niche product. Coke likes to play in different niches to see what can work and what might not, but it's willing to take a chance. And it's one of a few innovations it has in store for the second half that I think investors are embracing here.
Wait, forgive me. This is an innovation? Just switching the sugar? And it already makes it, as I know, it's something Tim likes and my husband loves because he'll order it like the Mexican Coke.
Comes in glass, too, which is awesome.
Exactly. So
maybe that's why it tastes good.
Help me understand, because innovation to me is something new and different.
Okay, so maybe it is not a full-blown innovation, but it's certainly a product that isn't mainstream. Let me put it that way. In the U.S., high fructose corn syrup versions of sugary drinks, Coca-Cola, have been really the mainstay primary version since the 1980s, just because it's less expensive. Most consumers don't know the difference. Some aficionados of soft drinks certainly do. And so I think it's going to be more of a niche product, maybe not an innovation. Maybe that's a little stretch, but we'll see how they brand it. in terms of, it's certainly going to be a premium price product if for no other reason to cover the cost. But I think it's going to be sold, in some markets like I said, at a premium price, not all their channels, most of the channels though.
How much more expensive is cane sugar from the U.S. versus high fructose corn syrup?
I would estimate about twice the cost on a per unit basis. That's a rough rule of thumb, but that's generally the way analysts look at it. And like I said, they've shied away from it. There hasn't been a high clamoring for it until recently. And so they're going to have some fun with it, too. They're going to come out with this, and they're going to see where it takes them. It's one of a few innovations, though. The company is really benefiting, maybe not innovation, but a trend, I should say, of the protein drinks. Again, not a new innovation, but it's certainly taken off because of consumers are recognizing that it's a great way to have a post-recovery. For the GLP-1 drug users, it's a great way to replenish maybe lost protein with the weight loss. There's been a recovery in sports drinks. So these are all areas where Coke's going to invest heavily in the second half to try to keep the growth engine going.
The business, just to tie it up here, the stock is a little bit lower today, but we've been bouncing around. It was a little higher, but it was down as much as 2% at its lows today, but it's now down about half a percentage point. The business at Coke they're massive still, right? They are a big player in the global beverage market, but their business overall, how would you describe it?
I would say today reinforced it's right on track. They pretty much reiterated their growth expectations for the year. Their long-term growth algorithm, as they call it, is for 4 to 6% organic revenue growth annually. And today was at 5%, and they still see 5 to 6 for the year. So it's right on track. With that and a little earnings leverage, they can try to get to mid to high single-digit EPS growth over the longer term. I think investors were pretty much reassured, I would say, today with today's results, solid results.
Yeah. All right. Really appreciate it. And shares of Coca-Cola, we should point out, they're up around 12% year to date. Hey, Ken, thank you so much. Ken Shea, Bloomberg Intelligence Senior Analyst for Consumer Products, joining us in New Jersey.
Does it actually taste better?
I'm not a soda drinker, except for ginger ale when my tummy doesn't feel good.
The only way for us to figure it out, blind taste test. We'll do it.
Let's do it.
Yeah.
I used to like Diet Coke.
Sebastian's going to buy the Coke for us because apparently it's very expensive.
Oh, is it?
The Mexican Coke. Yeah.
Oh, Charlie's giving it 2 thumbs up.
Okay.
All right. So let's go from one iconic brand to another.
Yeah, let's talk a little bit about what happened with General Motors. Profit fell as the company said it suffered a $1.1 billion profit hit from President Trump's tariffs. It revealed no plan for a near-term fix to return to pre-tariff profit levels. David Welch is in our Detroit News Bureau. He joins us from Detroit. He's been covering this company for years. He's been paying attention since early in the morning when that company reported results. The headline we're all talking about is that $1.1 billion hit. Break it down for us. How exactly did this end up hitting GM so hard?
Look, they have a lot of exposure because close to half of the vehicles that they sell in the U.S. are imported. So they're paying a lot in tariffs. There are things that they're going to do to try to mitigate those costs, but they're in the early days of doing that. So you didn't see the impact of that stuff in the second quarter. And even if all of it had come to fruition in the current quarter or in the previous quarter, it would only offset a third of that. So there's a long walk to get to the pre-tax profitability that the company had. And to do that, they're going to have to relocate production of some vehicles, some parts in the U.S. They announced a $4 billion investment, which will do some of that, particularly vehicles in Mexico. But they still import vehicles from Korea. They're waiting on a trade deal there. It's one of their top sellers, the Chevy Trax. They sell 200,000 of them a year, and it's getting hit with a big tariff on South Korea. So, these are not easy things to deal with. There is no quick fix for it, and you can't just pass the cost on to consumers because they're already paying very high monthly payments because car prices are very high and so are interest rates. So there's no real way out of that. And they had some other operational issues that had nothing to do with tariffs that also hurt their profits in the quarter. So all in, it wasn't like it was a terrible quarter without the tariffs, but it wasn't a great one either, and there's no easy way around that.
$1 billion on its own sounds like a lot. $1 billion hit, it's not something a company wants. Is it big in the grand scheme of General Motors?
No, it is. I mean, they're going to they're going to see exposure this year from tariffs of $4 to $5 billion.
Okay.
And like I said, they'll offset some of that, but that's a lot here. And so put it in perspective, their EBIT, the operating profit for the North American business alone was $4.4 billion last year, $2.4 billion this year. So, and that's their big profit generator, is that North American business. So half of that hit was tariffs, and there were other things like warranty costs, like building up inventory for electric vehicles, which they're selling more of and trying to really grow as a business. But those vehicles lose money. That's another area that actually hurt profits for them. But that took their EBIT down by 25% in the quarter alone, the tariff hit. So it is a very big deal, and it's something that they just can't easily rectify.
Well, on the rectifying this, David, somebody from the Trump administration, if they were sitting here, might push back and say this is exactly why we have this policy in effect. So the work that is done outside of the U.S. by workers who are not American will be moved to the United States and will then in turn be done by American workers. Is that realistic?
Well, they are going to get some of it back. Look, GM announced a big investment in the U.S., and it's worth 3,000 or 4,000 jobs, making pickup trucks and small Chevy Equinox SUVs that are made in Mexico. They'll still make some there, but they're going to make a lot of them here in the U.S. too, and also probably will take some production away from a pickup truck plant in Canada as well. So it is bringing jobs back. And the other argument the Trump administration would probably make is GM's not raising prices because it's not really clear that they can get a lot of pricing out of consumers. So really, the Trump administration is taxing GM, not taxpayers, not consumers, with these tariffs. So they would say, hey, it's not been going to be this inflationary thing that the critics said, and it's going to raise money for the federal government, and it's just going to hurt somebody's profits and disappoint some Wall Street analysts and investors. So that's the other side of this, and I think that's going to be the case with all the automakers going forward for the next couple of years.
Hey, listen, anything on the call or any questions that are still, you feel like, not completely answered in your mind or in the minds of investors as you reported this story out?
There is an open question about raising prices on vehicles. There's no way they could recoup all of the tariffs by passing those costs on to consumers. It's just too much money. Mm-hmm. But we have seen other car companies sneak in little price hikes here and there. Does GM start to do that at some point? Right now they're saying they're holding the line and they're not going to do it, but that is what we're really watching with GM and all of its competitors in the next 6 months, is what happens. As we get trade deals, there will still be higher tariffs. What happens with pricing going forward?
All right, going to leave it on that note. Hey, David, thank you so much. Bloomberg News Detroit Bureau Chief David Welch talking about GM and how the current administration policies are impacting the business. As we mentioned, shares of General Motors taking a little bit of a hit, down about 7.3%, so near their lows of the session, Tim.
Back to a headline that you mentioned just in the last few minutes, Carol. SpaceX has warned investors that Elon Musk could return to politics. Musk may serve in similar roles to his previous position as senior advisor to President Donald Trump and devote significant time and energy to such roles, this according to documents. It's great to have back with us Bloomberg Businessweek senior reporter Max Chafkin. Max is the co-host of the Everybody's Business and Elon Inc. podcast, also the author of The Contrarian, Peter Thiel, in Silicon Valley's Pursuit of Power. He's here in studio with us.
We
Max,
didn't expect to have you back this soon.
I feel like,
as much as we love it.
I feel like you knew something here when you told us that you never say never when it comes to Elon Musk and staying out of politics.
I mean, this is one of these things where any investor who's learning this from the risk factor statement of the prospectus is a little bit behind the curve. It's been pretty obvious for about a year that Elon Musk's political activities have a bearing on his businesses, but this, of course, is an acknowledgement of that. And also, I guess, Tim, as you're kind of hinting, maybe a suggestion that Musk has plans to re-enter the fore, although he sort of said as much on Twitter, a week ago when he launched the America Party.
All right. But does this take it to, if he's putting this language in the tender offer for SpaceX, I mean, does it kind of make it even more formal or official? I mean, does it take it to another level?
I mean, we saw these risk factors. I'm less familiar with them as they apply to private marketing fundraising, but of course they do show up in public market fundraisings as well. On quarterly reports, annual reports. I just had a quick peek at the last Tesla earnings release back in April. It had 2 new risk factors. One related to essentially perceptions about the stability of the management team, kind of a wordy way of saying negative stories about our CEO, and another about tariffs and a host of other things. So, I mean, I think this is more an acknowledgement of something that Musk himself has talked about. And this is not, I mean, maybe this, in some ways, I guess this is confirmation that people inside of SpaceX are aware that Elon Musk has discussed very recently plans to continue his political journey, and this is a reflection of that.
But how that journey could look might be a lot different than what that journey was over the last year or so, given the very public fallout that he's had with President Trump. Do you think it would take the form of a new political party and supporting candidates, perhaps Democrats and Republicans, who maybe want to slash the deficit?
Well, we've talked about this a lot. We've talked about this here some and also on the Elon Inc. podcast. I think there are reasons to be somewhat skeptical of a political party in the formal sense, like another effort to start like a reform party or some true alternative. I think the idea of Elon Musk somehow trying to formalize this political movement, in the same way that the Tea Party is not an actual political party, it's like a constituency of voters. You could imagine something like that. And what Musk has said is, or hinted at the very least, is a plan to back certain candidates in the Senate and in Congress, and then try to use that to be, as a sort of point of leverage in negotiations over bills and so on. And I think, there's something to be said for that, right? If he were able to, say, peel a few Republican Senate or House votes away, like that would give him more leverage over Trump than he has now. There are also reasons why this could backfire spectacularly.
All right, let's just remind everybody, as Max has been reminding us, that, he has talked about, kind of staying exposed to politics or staying in politics. We're talking about Elon Musk. In fact, here's what he had to say on May 30th from the Oval Office.
I expect to continue to provide advice whenever the president would like advice.
I hope so.
I expect to remain a friend and an advisor, and certainly if there's anything the president wants me to do, I'm at the president's service.
All right, again, that was Elon Musk there with Donald Trump, the president of the United States, back on May 30th. So, Max, if we read something like this, I mean, who knows? Is it going to be what?
Was that the day with the black eye?
That was the black eye.
Okay, I just wanted to.
That was
parenting mishap.
Yeah, sorry. The reason I ask is because you were on our program yesterday. The whole big take. It's the cover of Bloomberg Businessweek. The issue is on my desk.
Right,
yeah,
and this is all about this. This is like the
no.
financial filing equivalent of a black eye, right? An acknowledgement that there is risk here and risk for his companies. I mean, just now as we're talking about this, Musk has been tweeting sort of semi-taunting the Trump administration over reports around the Golden Dome, reports that the Defense Department might look for alternatives to SpaceX. So he's obviously moving into a sort of different position relative to the Trump administration. I'd say it's kind of similar to the one he had with the Biden administration, although, of course, Musk's politics have changed quite a lot since then.
Yeah, I guess that's what I was curious. Like, is it that he's going to go back and become buddy again? Or we just don't, in what form? Or is he kind of like this and just figuring out a different involvement in US
I mean, I think Musk has carved out an identity that puts him to the right of President Trump on a whole bunch of issues. You brought up the deficit, but of course he talks all the time about, identity politics, about sort of cultural issues, always, taking a more or less right-wing position, and that's kind of where his fandom is, and that to the extent that he has a political platform, I'd expect it to be a right-wing platform, further to the right than the Republican Party for sure. But of course, there's also an element of self-interest, right, where a lot of his positions coincide with the interest of his companies. His companies, as I've said a bunch of times on this program and others, are either heavily regulated by the U.S. government or dependent on government contracts. So it's going to be my guess and my supposition would be some combination of Musk's, own political interests and fixations, along with, self-interested policies. So you could imagine very conservative on cultural issues, perhaps, but probably like a little bit less conservative on the question of funding, green technology companies and so on, because of course that's what Tesla is to some extent.
We'll see. I don't know.
Yeah, day by day.
Hey, this is a great story, though.
Yeah.
Dana Hull, Lauren Grush, Ed Ludlow, SpaceX warning investors that Elon Musk could return to U.S. politics. Max, before we let you go, is this more the lawyers covering themselves than it is an indication that Musk is going to have a new adventure?
I think more or less. And I think anytime you see something like this in a filing, obviously lawyers, as much as Musk has a stated view that is not super positive about lawyers, my assumption here is that this is lawyers and investor relations types trying to cover their bases.
But he signs off on it,
of course,
right? Yeah. So he's all in on this as well. Shares of Tesla, by the way, they're up about 1.8%. So one of our metrics on this. Hey, be ready. Have your pager or whatever the heck ready, because we may call. I know.
The Max signal.
Your Starlink up and running, because we may reach out to you again. Of course, that is Bloomberg Businessweek senior reporter Max Chafkin. He is co-host of the Everybody's Business and Elon Inc. podcast and the author of The Contrarian.
Our stocks are moving a little higher as we speak. Let's get an update from Charlie Pellet. He's got his eye on everything happening in the markets. Hey, Charlie.
Thank you very much. Here's what's going on. S&P 500 index higher now by 6 points. That is a gain of just about 0.1%. We've got the Dow up 150, higher by 0.3%. Traders gearing up for the start of the mega cap earnings season. Right now, though, NASDAQ tech stocks trading lower. NASDAQ down by 0.3%. NASDAQ 100 index down 0.4%. Alphabet, which reports tomorrow, up 0.5%. Tesla, which reports tomorrow, up 1.8%. The Mag 7 index, though, down 0.3%. 10-year 4.33%. The 2-year 3.82%. Gold up $33 the ounce, up 1%. West Texas Intermediate crude down 1.5%. Briefly, number of defense companies reporting earnings. We have got Lockheed Martin plunging 8.5%. RTX down by 1%. Northrop Grumman up by 9.7%. So again, U.S. stocks trading mixed. S&P 500 index right now higher by 5. That is a gain of 0.1%. Ozzy Osbourne, Black Sabbath singer and godfather of heavy metal, dead at the age of 76, only weeks after his farewell show. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Hey, Harvey Schwartz, he is the chief executive of the Carlyle Group, finds himself at the center of a Wall Street revolution. So writes our Sonali Basak. You've got Carlyle shares outperforming rivals this year as the private markets industry takes on traditional lenders and attracts clients who have otherwise gone to firms like Goldman. Schwartz, by the way, is the subject of the 6th episode of the first season of Bullish. Hard to believe it's wrapping up already, with Bloomberg News global finance correspondent Sonali Basak. It is also the season finale. It is on Bloomberg TV tonight at 6 p.m. Wall Street time and on Bloomberg Originals at 8 p.m. Wall Street time. And you can find it already on the Bloomberg Terminal.
The episode already live on the Bloomberg Terminal and at Bloomberg.com/bullish. Sonali's here in the Bloomberg studio with us. I want to get to the episode in a minute, but first give us background on the Carlyle that Harvey Schwartz inherited when he joined as the CEO?
It's a good question, because remember, Carlyle was a firm that tried to do a succession plan, and the CEOs they chose, one ended up being Governor Youngkin, so left Carlyle, and the other had also left the firm. So when they looked for a new CEO, Harvey Schwartz came in. The stock was lagging behind rivals with all of this management change. This year it's doing really well, actually. It's up 18% or so, where a lot of the rivals are down. So there is a lot of sign of progress. But you have to remember, this is an industry changing very, very quickly.
Right.
The private equity industry in particular has kind of gotten a tough rap, but they have been pivoting further and further into credit. Private credit has been a bigger thing for a lot of these companies, as well as private wealth. So expanding access to the private markets to individuals at the brink of them possibly becoming more available in 401ks. So that's kind of what's the backdrop to all this.
You covered so much ground, but on the private markets, you guys, the two of you, you and he, talked about some of the concerns, especially amid that explosion in private credit. Here's a little snippet of Bullish.
So one of the great things about the industry is And one of the things I've loved about it is it's constantly reinventing itself and constantly evolving in terms of what is the most efficient way to provide capital to an enterprise. And that's why private capital has grown. Now, more people want access to being providers of that capital. And I think this is, again, just a part of the natural evolution of how people access capital. We haven't opened up that marketplace in a way that gives a broader community access beyond the wealthy. And obviously it should happen. It's actually happening indirectly. Retired teachers all over America participate in plans for which Carlyle is helping those plans manage their assets.
Do you worry that maybe this industry could fly away a little bit if there isn't a bigger set of eyes on it?
Do I think we could have a bad credit cycle? Sure. The question is it systemic in that it actually triggers a broader crisis? Banks have failed, but we haven't seen credit funds fail.
And that, of course, is Harvey Schwartz, the chief executive of the Carlyle Group, with our Sonali Basak and the season finale of Bullish, which airs tonight on Bloomberg TV at 6 p.m. Wall Street time. You know, okay, not yet. And I feel like everybody who's in that market is just like, you know, the pros and cons, and we haven't seen a credit cycle or private credit cycle fail, at least not yet.
Yeah, it's certainly in the minds of a lot of investors. And, you know, one argument the private asset industry will say, of course, is that it's not deposits that they're taking here. And what I'm hearing, you know, just a little bit of color behind the scenes, is there isn't a lot of concern about the biggest firms. But remember, this has become not only a very crowded space, and Carlyle is one of the biggest, but the asset class of just direct lending is actually already bigger than the syndicated loan market. So that's just the scale of how big it's gotten, and it's quickly catching up to the high yield market too. So just enormous numbers we're talking about here.
A big focus for this firm and the other firms that are in the space, and so-called alternative asset firms rather than private equity firms, has been private credit. What about the original private equity, though? Is he moving away from that at all?
So Carlyle, and I'll also include Blackstone and Apollo and KKR, there are private equity businesses. They're just becoming a much smaller percentage of the whole pie. And so private equity, the question is, how quick can they monetize assets? Interestingly enough, Carlyle has kind of been one of the first out of the gate here to start to IPO companies, start to get back in and buy and sell companies. I would remind everyone too that, you know, KKR in the market doldrums in April spent billions of dollars in like a week, right? So private equity's not over, but there's certainly a lot of questions. A great story on the terminal today about how mid-sized private equity firms are facing a lot of struggles against these massive giants in the room. If you can't write big checks, it's kind of tough to play in the space.
I know we've run out of time, but 30 seconds. It's a very personal story. You also get into him, and you talk about his parents who dealt with serious mental health illness. It made me stop. Just a little teaser for those folks who are listening, because it's what's going on at the firm, but it's also his story.
The most unusual story that I've heard on Wall Street, particularly for a CEO. And he does talk a lot about mental health because of the struggles he had growing up. The high school we went back to, he actually failed out of. He never graduated from there.
Right.
And so he and a few others that I've interviewed have one big theme, which is knowing your luck and being able to take advantage of that luck. And it's worth a watch for anybody who's entering Wall Street.
Incredible reveal, and very, very deep and personal. No doubt about it. Sonali, thank you so much. Really appreciate it. Bloomberg News Global Finance correspondent Sonali Basak. Catch the season finale of the first season of Bullish, featuring Harvey Schwartz, the chief executive of the Carlyle Group. All right, when we come back, we'll get a check on trading for you and some stocks on the move. You are listening and watching Bloomberg Businessweek Daily. I'm Carol Massar, along with Tim Stenovec. This is Bloomberg.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody. Carol Massar, Tim Stenovec, and we are just coming up on about an hour to go until we wrap up trading on this Tuesday. And stocks have been bouncing around a little bit today. We're back up near our best levels of the session. We're back in the green, so we're looking at maybe another record on the S&P 500. We're up about 9.5 points, 63.15. You've got the Dow up 174 points. Not so. A lot of big tech names are dragging down the NASDAQ 100 today. Tim, you've got the NASDAQ 100 down by 83 points.
We'll see what happens tomorrow after the bell. Tesla is set to report results, so we might see a big move there. We'll also hear from Alphabet after the bell. So we'll see, Carol, if those kind of change the narrative around what we've seen so far. It's early.
Yeah, it is early, but these will be very important in terms of sentiment and momentum. I'm Carol Massar along with Tim Stenovec. So let's get to some stocks on the move today. With us is Bloomberg News equities reporter Norah Mulinda. All right, Norah, stock number one.
Plethora to choose from today, but I'm looking at shares of D.R. Horton. That's ticker DHI. This is one of the stocks that I actually cover. It is a home builder, and it's one of the bellwethers in the industry. We're seeing shares up this afternoon, and this is after it reported orders that topped expectations and a third quarter EPS beat. And so this is really good, especially if you think about the sluggish housing market. This is great news for the sector. So we're seeing a widespread rally coming off of this, as we're seeing a lot of these other companies like Pulte Group, which also reported earnings, rising in sympathy here.
What's the good news, though? I mean, is it because if we...
I know, right? What is the good news?
Well, if we take what we heard from the president earlier today about interest rates and about people not being able to afford homes as a result of that. Rates are still high. There are concerns about construction costs, so I guess expectations were not high.
I mean, there's definitely a lot of overhangs right now when you think about the broader real estate industry, but particularly residential real estate. And we know that D.R. Horton actually targets some of the entry-level buyers and the move-up buyers. And it's interesting because if you think about the average, millennial or people who are looking to get a new home, I don't really hear that many people saying that they're closing. So it's interesting that we are getting these results, but we do have Zelman, the analyst there. They're pointing out that while this was a solid report here, we did see that management tweaked the midpoint of its 2025 revenue and closing guidance. That's a little bit slightly lower. So we do have analysts that are really still trying to see if they are still offering these incentives, because they used to do a lot of these buy downs where they would buy down the rates to make it cheaper and, throw in a dishwasher, throw in some fun things to make it make more sense.
Buy points and so forth, right? Oh God, she was aggressive and really smart. But, I should point out that home building stocks as a whole, they're up about 10%. So investors taking note.
Quite a day.
That you had D.R. Horton and Pulte, both come out with some news that has caught the attention of investors. All right, let's go to stock number two. Where do you want to take us?
Let's go to Lockheed Martin. This is the other industry that I cover, aerospace and defense companies. So we're seeing ticker LMT. That's the worst performing stock in the S&P 500 today. Really seeing a decline. It was earlier down as much as 10%. That's the biggest drop since October of 2021. And we're seeing a stock that's down about 14% so far this year. But what people are really taking away from these earnings today is the fact that it had a $1.6 billion amount in charges and a possible tax hit. And that's what's really set the stock tumbling. But we do see a lot of the things that have really been a headwind for the stock is the fact of the criticism that it's really been receiving regarding its F-35 jet. So lots of cost overruns and delays that has really been riddling the company here.
They also didn't get the F-47. That was the new plane that was announced back in March, I believe, that ended up going to Boeing instead.
No, absolutely. So, I mean, there's a lot of things that people have really been parsing as it pertains to this company, and it seems as though Wall Street's quite critical today, but not super surprising because I think people had expectations that were kind of low coming into aerospace and defense earnings. We do see Northrop Grumman as a gainer right now, but overwhelmingly, you are seeing a bit of people sour right now when it comes to aerospace and defense.
Potentially $4.6 billion in additional taxes owed after an accounting change. And apparently, I guess they're talking with the SEC about this or contesting the matter with the Internal Revenue Service. But I mean, that would be massive.
Absolutely.
Massive.
I mean, we're looking at the stock
if it's a one time, but
yeah. I mean, I think that these are some really interesting things that it seems like people are really pointing a finger poking here.
All right, let's poke at KSS.
That was a good one.
Thank you.
Yes, so we're looking at shares of Kohl's, and this is interesting because we've really been seeing this meme stock rally returning. Another company that I cover is Open Door Technologies, that's ticker Open. And we're just seeing a wide-based rally right now between Kohl's and Open Door. But let's look at Kohl's here. We're actually seeing this, of course, because of social media chatter, as is typical when we think about these meme stocks here. We're seeing shares that doubled, more than doubled this today throughout trading. And we are seeing shares that are up about 86%. That's insane as we speak right now. But we are seeing it fading a little bit, earlier up as much as 105%. But this is really just Kohl's ripping right now. And a lot of people are pointing back toward that 2021 meme stock script that we were seeing played out with GameStop and, of course, all the others.
49% of the float is short interest.
Yeah.
Just really saying.
You always bring up the short interest, Carol.
I know, because it's like, it tells a story.
So,
it does.
It means investors are not all in.
last week.
Or they might have to do a bunch of short covering.
Crypto assets at $4 trillion. Bitcoin around all-time highs. Meme stocks are being memey again.
Is this an everything is awesome?
What's going on?
Kind of moment for us? It is kind of fascinating to watch. Norah, thank you.
Thank you.
Bloomberg News equities reporter Norah Mulinda. Hey, for more conversations like this, be sure to check out our Stock Movers podcast, 5-minute episodes, biggest winners, biggest losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts.
Hey, coming up next on Bloomberg Businessweek Daily, we are talking meme stocks. The guy who set off the frenzy with Open Door, the hedge fund manager, joining us next.